For the last 3 decades, Knowledge Center at Bursa has offered technology, resources, services, space, and a sense of community. Since 1985, 14,000 titles have been collected, with care and attention to high financial literacy standards. In collaboration with a global community of institutions, we ensure access to the world's diverse intellectual and cultural economic heritage, as well as fast online services for connectivity to the financial world. Serving the Bursa Malaysia community and beyond, Knowledge Center at Bursa empowers you in your trading and investment analysis research.
Financial information at my fingertips.
Visit Knowledge Center at Bursa Malaysia today for the collections, for the services, for the sense of community.
You have suffered financial loss while investing, and you think your bank, broker, fund management company, unit trust management company, PRS provider or distributor, or their agent or representative is responsible. You need help sorting out the problem or want to seek redress. Where do you go? Sidrec is here to help you start the conversation and reach some resolution. First, lodge a formal complaint with a company that sold or offered you the unit trusts, shares, derivatives, or other capital market product or service. But you're not happy with their response. You have 180 days from their final written reply to come to Sidrec. Or if there's no written response, and it's been 90 days since you wrote to them, you don't need to wait longer. You may come to Sidrec even though you haven't received a final response yet. Sidrec first checks the eligibility of your claim. For example, is it within Sidrec's claim limit? Is it against a member of Sidrec? And so forth. If your case is eligible, we begin the dispute resolution process. All information in this process is confidential. We get both you and the member you're complaining against to sit with us and have a conversation. Documents and information will be required from both parties. No lawyers are allowed in the mediation process, as we keep the discussions informal and private. Our mediators are impartial and will hear both sides out and help parties communicate constructively towards resolving the dispute. 2 outcomes are possible at this stage. Either both you and the member agree to a settlement, or you don't. If the both of you agree to a settlement, an agreement is signed and the mediation process ends successfully. But if both you and the member fail to reach a satisfactory resolution, mediation has thus failed. But don't worry, Sidrec then proceeds to the next stage, adjudication. During adjudication, parties are given the chance to provide any further information to help their case and ask each other further questions. Our adjudicator will then study and consider all facts and information provided, including the conduct of the parties, laws, and best industry practices, as well as what's fair and reasonable. Sidrec's adjudicator will then make a final decision on the dispute and the monetary claim. If the decision is in your favor, it could be a full award or a partial award for your claim. But if the decision isn't in your favor, then no award will be made. You, the investor, will still have a choice. If you reject the decision, Sidrec will simply close the case and you may seek other legal avenues for redress. If you choose to accept the decision, however, the member has to comply with it. Once the parties have confirmed compliance to the decision, Sidrec will close the case. So let Sidrec help start the conversation towards resolution. For more information, visit sidrec.com.my or call 03 2282 2280.
Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by LifeChamp. Today, we are very excited to be doing this webinar's topic that is titled Design a Complete Game Plan for Trading Stock Markets. So how is everyone doing? So this is Shen Chu. I'm the moderator for this webinar. Now, as you know, whether you invest or you do trading, we all need a plan. Because if we fail the plan, we plan to fail. Okay, so today we are going to look into various aspects on how we should design our plan so that we can succeed in the stock market consistently. All right. So as usual, disclaimer, whatever we share on this webinar is only for educational purpose. So in no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. So if you decide to make any investment decisions, you're 100% responsible for all your investment risks. So allow me to briefly introduce our speaker, and he's none other than Mr. David Loh. Now, David Loh is a trader and managing partner of Exmodius Trading Group PLT, a consultancy firm specializing in bespoke trading strategies and coaching for private and corporate clients in equity commodity derivative markets. So he has 25 years of experience in the Malaysia listed derivative industry. Before starting his own consultancy, David held leadership position in futures brokering divisions of major investment banks in Malaysia. He also served as the president of the Malaysian Futures Broker Association between 2018 and 2019. So as a fervent believer in trader education, David has spoken in seminars and workshops to over 5,000 retail traders on trading the Bursa Malaysia's derivative as well as the CME, SGX, Hong Kong Stock Exchange markets. His work includes live market trading sessions and webinars. So he is some traders who is really experienced in trading, right? So we are very honored to have you here, David.
Wonderful to be here this evening.
All right, cool. So without further ado, let me hand over the control to you, yeah?
Okay, just let me share my screen. Okay. Shane, is that good?
Yes, perfect.
Okay, so let's go. Thank you, Shane, for the wonderful introduction, and a very good evening to everyone joining us this evening for this night's topic, design a complete game plan for trading the stock markets. We will be going through a lot of very interesting stuff, okay? Some of you know some of this stuff, okay? Some of you may find that a lot of new things as well. So I hope everybody joining us this evening will have a good productive session and will find things they can use after this evening session. Shout out to all of you joining us from YouTube Live, right? How are you guys doing? Hope you guys out there are doing well, and welcome also to the webinar. Okay, so let's start. Okay, let me get this banner going first. All right. Okay, so this is done and this is done. And this is what we are going to talk about. Okay, three very important points that we are going to cover this evening, right? The first is identify your individual trading and investment goals. Okay, this is a very important starting point for everyone in trading the markets. Okay, so whether you are someone new or whether you have been trading for a while in the stock markets, okay, it is very important to always as well to identify your trading goals, and also for those already experienced to recheck and to see whether you have these trading goals, or review your trading methodology, or even your investment strategies. Okay, but first start by identifying what you want from your trading and your investment goals. Okay, so this is a very important point that we will cover. And after that, from the goals that you have and what you want to get from the market, then you go in and determine what is the optimal trading plan for you to achieve these trading and investment goals. Okay, so we start by knowing yourself, and then later going into the market and find what types of trading strategies will be suitable for what you want to do. All right. And at the end of it, of course, once you get on started trading, you also need to know, okay, and know how to analyze and review your trading and investment performance, okay, so that you're staying on track with what you intend to do, right? So we will talk about these 3 points, okay, and expand on all these 3 points. So let's get started. Okay, so before we jump into the main material, okay, those of you who have been trading for a while or who have been searching for information for a while on YouTube channels, on Google, I'm sure you will have a lot of these advertisements popping up right in your face, okay, telling you about what is a good strategy, right? They have this fantastic strategy, and a lot of people say that, no, how you can sack your balls and trade full time, how you can make $1 million just by investing a few hours per day. They can teach you how to do that, or they have the insider secrets to making it big in trading. So a lot of people have a lot of promises on a lot of advertisements, right? And then a lot of them claim that anyone can be, you know, a stock trader or day trader instantly. Okay, so there's a lot of hype in trading. Okay, and a lot of people, I think, get taken in by it, right? So the thing is, what is the reality of trading, right? Is it really that easy? You know, so easy to sack your boss, trade full time, forget about your job, okay, make millions with their secrets, okay? But it's interesting, you know, is this smart or stupid? But if you think a bit deeply, right? You have all these people telling you they have these insider secrets, yet they have to sell you into a course. Okay, what does that mean? Okay, so I think you are able to get the drift, lah. You know, and hopefully you don't get too caught up with the hype. Okay, of course, I'm not saying that all of them don't have valuable information. Right, a lot of them also have valuable information, but you need to be very, very careful about promises being made to you in terms of trading and investments in the stock market, right? So this is something that we want to start with, okay? But I want you to understand the reality of trading, okay? So the reality of trading is very, very different from the hype, okay? That a lot of these system sellers or people who want to sell the courses will, what do you call that, represent, okay? Because if you really want to be good in trading, okay, this what do you call that? Plan of yours, okay, will require a lot of knowledge and skills, okay, together with a lot of work and dedication. Now, this is something that a lot of them don't tell you, okay. So a lot of people think that they can be an overnight success, they can make a killing in the stock market instantly by having some very, very special, super secret information, right? But it's actually, there's no secret in terms of trading, okay. A lot of the whatever secrets that are promised can be found online, okay, or in very, very good trading books. But the important thing is work and dedication, okay, because to be successful, like in all other business, you have to put in the effort, right? So successful trading is actually a process, and it's a process of developing and executing a winning trading strategy, which has 3 very important components, okay? And these are the components that I will talk about and let you know where are the important critical points you need to know about these 3 points, okay? The first is trading methodology. And the key thing about your trading methodology is the trading methodology needs to have an edge, okay? And how do we find an edge? Later we'll see, okay? How do you analyze whether your trading methodology has an edge, okay? Number 2 is money management. Again, this is very, very important part of a trading strategy, okay? You need to be able to manage risk, and you need to be able to know how to size your risk when going to the market, okay? So that comes under money management. And the third and a very important part is the correct mindset, okay? What is your mindset when you're trading, okay? Because that really determines your style when you're trading or investing in the stock market, right? Because mindset and trading psychology is tied together very, very closely, right? And we also will cover later, talk about how to learn lessons from successful traders and professional traders, and also talk about a very important point, okay? Because trading, okay, trading requires actually adequate capital to succeed, okay? So what do you call that? You can't just like take a few $100 and then make it into millions. Some have done it before. I'm not saying that it cannot be done, okay? Some have done it before, but the odds are very, very much against you to be able to do that. So adequate capital is something that we will talk about as well, right? So that's the reality of trading, right? And let's now go to the first part, which is evaluating your trading and investment goals, knowing yourself. This is one of the most important starting point for taking and planning and designing a trading strategy. All right. So this is a very famous quote from Sun Tzu, okay, from The Art of War. Okay, this is a very famous general during the ancient times. And of course, a lot of you know this name, Sun Tzu. He is a strategist in terms of war, and his book that he wrote, The Art of War, actually has a lot of quotes and a lot of information they can actually use in terms of trading. I recommend The Art of War for anybody who's learning how to trade, because there's a great philosophical, knowledge there. Okay, and this is one of his quote, okay, which is very famous. A lot of you may know it in the Chinese language. I can't speak Chinese language, but a lot of you know it in the Chinese language as well. You speak this lingo, right? So if you know the enemy and know yourself, okay? So know the enemy, know yourself. You need not fear the result of 100 battles, okay? So you're very, very confident you will win, okay? If you know yourself but not the enemy, that means you only know yourself but not the enemy, for every victory gained, you will also suffer a defeat. And if you know neither the enemy nor yourself, then you will succumb in every battle. Okay, so a very important component of trading in the market and fighting the battle in the market is knowing yourself, right? So let's go in and check this out. The very important things is you need to ask yourself these few questions that you will see coming in front of you, okay? These are self-assessment questions, okay? You need to ask these very basic questions and continue to ask as you go on to this trading journey of yours, okay? The first is, why do you trade? Okay, this is something that you really need to be very clear. Ask yourself, why do you trade? Okay, why do you go into the market? What is your motivation to trade? Okay. Okay, some people will say, okay, I want to trade for a living. Okay, very good. That's a very good ambition to have. Okay, some of you may say that, okay, I'm getting retired. I need to do something. Okay, I have a nest egg. I want to trade my retirement funds. Or some of you may go into the market and trade because you want to build a nest egg, or you want to build a retirement fund. Okay, fantastic, very good things. A lot of people also going into trade for thrills. Okay, some people are bored. Okay, they find that the stock market is a fantastic place to get some excitement. Okay, and I'm telling you, these days the markets are very, very exciting. Okay, and some people trade it as a pastime or a hobby. Okay, now you really have to ask these very serious questions, because how you approach trading, whether you are very serious or just for fun, okay, will determine your long-term success. Okay, so these are the first important question. The second is, you need to ask yourself how much time you can commit to trading. Okay, so if you are retired and you can trade full-time, okay, fantastic, right? So you have to ask yourself, do you have a lot of time to commit to trading? Okay, because time you need for watching the screen. Okay, if you're a day trader or full-time trader, you need to be watching the screen. Yeah, if you are fully full-time employed in a permanent job, it may not be practical for you to trade, say, day trading, for example. Okay, because day trading requires you to have screen time to watch the screen. Okay, do you have time for analysis? Okay, so your time for analysis will determine what sort of market analysis can you do. Can you do like fundamental research, or can you do or you prefer things like technical analysis, right? So those are the things as well, whether you have time for analysis. And of course, the last one is the time for trade management. Okay, looking at your orders. Okay, putting in orders and all that. Do you have that kind of time? Okay, so whether you have time for all these different commitments in terms of what will be needed in order to trade, you have to ask that question seriously, because that will determine your trading style as well. Okay, so the next one is this question. As I said just now, capital is a very important thing. How much capital you can commit to trade? Because when you trade, or if you put your money into the market, this is called risk capital. Okay, so is your risk capital that you put in the market really risk capital? It's a very important question you ask, right? You cannot be putting in milk money to trade in the market and put at risk your milk money, right? Yeah. What is your risk and loss appetite? Can you take a loss? Okay, that will determine your strategy as well, whether you can take a more aggressive strategy or you might have to take a more conservative strategy. Okay, so how much capital you have can also restrict or not restrict the way you trade. Okay, and the last one is psychological comfort. Okay, so some people have the money, but they are not comfortable in risking a large sum of money, right? So that everybody has a certain limit in terms of what sort of physical or psychological comfort when it comes to risking money, right? So that will determine in terms of your risk and money management, what types of strategy you will employ in risk and money management. Okay, so that's those are important points that you need to ponder as well. Okay, and on the right side, of course, you can see what is your return expectations. Okay, everybody have very high expectations. Okay, so some people will say that okay, if it can return me 10 to 15% a year, that is fantastic. I'm sure a lot of you will agree that 10 to 15% return is fantastic. I mean, you just look at what is your FD rate. Okay, although it's gone up in the last couple of months, but then if you can consistently take 10 to 15%, it's fantastic. Okay, but so to some people, 10 to 15% may be unexciting, right? To some traders, what is 10 to 15%? Okay, they are thinking of monthly returns of 10 to 15%. Okay, not to say annual returns. Yeah, is that possible? Well, that's possible if you have a strategy for that and if you are good at that, okay? Or are you going for killing? You going for that 10-bagger? You going for that 1,000% return kind of thing, right? You have to consider the risks and rewards when you think of in terms of the return. Okay, so there's no free lunch in terms of returns. Okay, the other thing is whether you can achieve those returns also will depend on your skill, okay, your knowledge and your skills. So these are very important because your return expectations will also determine what type of trading style you will employ. All right. So what is your skill level? There's a very important thing that will determine your returns, okay? Are you just starting out, okay? So in terms of if you're just starting out, then you really need to up your skill and knowledge in terms of that. Or if you have been quite a seasoned trader, okay, where are the points that you need to polish off, okay? So this is a very important thing, right? In terms of experience, experience is not judged by the number of years, but actually how much exposure you have and how much, what do you call it, trading time you've put in. Okay, it's like flying. Okay, how much flight time you have, right? So trading skills as well. So understand that in terms of trading is a skill. Okay, and it must be practical in terms of the reality of trading. I told you about just now. Trading skills need to be acquired. It's a lot of people. I think if you seen some of your friends, okay, maybe yourself experience it. In the year of 2020, we had a tremendous run in the market, local stock market. Okay, so a lot of people joined the sort of the bull party, right? So some of you may have been in that pool party, right? So a lot of people also made a lot of money, right? Okay, so was that skill? Was that knowledge? Or was just pure luck? Okay, so you ask the same people that made a lot of money to then what happened to that money? Okay, where has it gone to? Okay, and then you can realize that some of them may have not been able to keep the money or holding on to losses until today, right? So do not mistake skill and knowledge from luck. Okay, luck and skill and knowledge, two different things, right? So making money is not a measure of your skill and knowledge, right? So it's making money consistently over time. That's very, very important. Okay, so in terms of methodology as well, what methodology do you employ and what market analysis skills you have in that sense, right? So it's very important to ask yourself this question because that will set the expectations for returns as well. Okay, and the last question is, what are your trading beliefs and your psychology? Okay, your risk appetite, your risk tolerance. Okay, what is your confidence level? Okay, how confident are you in your methodology, or you basically don't even know whether your methodology will work in the long run? Okay, so later we'll see. I'll show you a method to check whether your methodology is something that can work in the long run. Okay, so the other thing is whether you have discipline. Okay, discipline to follow a plan. Okay, discipline to follow a methodology. This is very important as well. Okay, and the other thing is the realistic expectations we spoke about in terms of your skill, what sort of returns. You must be realistic. Okay, understand that you want to be successful in this in the longer term. You need to put in the work. All right, so these are the six very important questions to ask yourself before you embark on your journey to trading, right? Even if you're on that journey to trading, it's very good to go back and ask yourself this question to see whether you have diverted or you've crossed into a wrong path, or your path now has leading you to the wrong way. Okay, so this is very, very important, right? So after having known this, okay, then you need to know the building blocks of your trading strategy. Okay, so now we go in and talk about the trading strategy and your trading plan. All right, so let's move on. Okay, so in terms of the building blocks of a trading strategy, the important thing is these three things. You need to have a methodology. Okay, we spoke actually in the last series, last segment of the series that I did. Okay, about the methodology. Okay, you need to have the money management, what do you call that, strategy, and you need to have and understand your trading psychology. So all these three added up will become your part of your trading strategy. Okay, so you may be quite curious why the circle seems to be of a different size. You see, why do I put methodology in a smaller egg, money management in a larger egg, compared to methodology and trading psychology being the largest egg? Okay, so in terms of the importance, as you move into your journey on trading, you will find that in the end, after you've mastered or at least have a very sound methodology, and after you can implement your money management, the one that is going to stop you to your ultimate success will be your own trading psychology, right? So that's what we spoke about, the mindsets of the trader is very important. Okay, your confidence, your discipline is very, very important component. Okay, so we will go in and talk about that afterwards. Right, so let's move on. Okay, so when we're talking about trading methodology, okay, which is what approach are you going to use in terms of your trading methodology? Okay, are you going to use, basically can be divided into, categorized into two types. Okay, one is called the discretionary approach. Okay, so what is discretionary approach? And this is a popular approach. Okay, why is it popular? Because it's a lot of people start this way. Okay, because they never really ventured into looking at a very good method. Okay, so everybody mainly starts this way. Okay, so you enter and exit trades based on feel. Okay, what does that mean? Based on feel. Okay, so basically a lot of people have some knowledge. Okay, some read the news. Okay, they read the news and then see something very interesting coming up in some companies. Okay, or they can read some charts. Okay, because they've seen some YouTube videos of they study some charts, they read some charts. Okay, or they hear something. Okay, and hearsay and hot tips, you know, it's one of the very popular ways to get news on some hot stock, right? So after having this chart pattern, read some news, hearsay, hot tips, okay, you will hear themselves, or you can hear yourself say, okay, I feel I can buy this stock. Okay, now when you see or hear yourself say I feel, okay, after seeing a chart, I feel can go in now. Read news, I feel this stock is good, right timing, hearsay and hot tips, wow, I feel. Okay, when you hear yourself in your head saying I feel, this is called the discretionary approach. Okay, why is that called discretionary approach? It means that your decision is made by the trader. Okay, then you say, David, hey, isn't it obvious? All decisions are made by the trader. Yeah, yes, true. I understand, but you'll be the one executing the what do you call that, the order into what do you call that. But then you need to distinctly remember what is this decision. The trade is done by the trader, of course, but the decision is made by the trader. That means from the I feel feeling. Okay, whether it's news, charts, or hearsay, okay, it's made by you, okay? Okay, if you don't understand what I'm saying, let's consider the next approach called the mechanical approach. Then you will understand, okay? Mechanical approach is rule-based, okay? So every time you go into the market, there's a rule why you go into the market, okay? Why you enter the market, okay? There is a rule. Whether it's a technical chart rule or whether it's a fundamental, certain fundamentals meet your ratios, you go in, okay? Exits as well, they have the rules, right? So this method is structured, disciplined, and non-emotional. Okay, there's no, ideally, there's no feel. I don't feel, don't feel, then you buy, the system and decisions is made by the methodology. So this is the distinction between the mechanical approach and the discretionary approach. Okay, so decisions made by trader and decisions made by methodology. So that's a different, the very big distinction there. Okay, so there is a methodology, there's a method that says that, okay, this rule has been, this criteria has been met, whether fundamental or technical analysis, then I'll go into the market, okay? And when do I get out? When I get out, when this certain signal come in or certain of the ratios do not show or no longer reflect the figure that I want, then I get out of the market, okay? So this is a very important thing to understand, right? And if those of you who are starting out to trade, I would highly recommend that you try the mechanical approach, okay? It's not that discretionary approach cannot work, okay? Some very seasoned traders have the system inside them, okay, in terms of they have the rule base inside them already. It's like they are in a way, you can say that they are in that experience, are very talented in that sense. They can do it, okay, but not everybody can do this, okay. And when you ask them how they what do you call that, achieve the success, a discretionary trader will not really be able to tell you the methodology, okay, yeah, because it's based on that particular field that he has, right? So mechanical approach is something that I will highly recommend for those starting out, and those who have not used it before, I would really recommend that you try a mechanical approach to trading, all right? So you have rules-based for entries and exits and a very structured and disciplined way so that it removes emotion from trading, right? Okay. So in terms of the trading methodology, of course, after you determine your approach, then you look at the setups, your analysis, how you analyze when to enter the market, how you identify the trade, whether to go in or go out, okay, your rules, your trading plan, okay, how if the market goes against you, what do you do, okay, if the market's profitable, what is the strategy of taking profit, okay. And lastly, of course, is part of the trading methodology, you will need to have a way to measure your success, okay. You need to analyze the data from your trading, okay, and this is something that a lot of people don't do, right? They analyze the thing by looking at their balance at the end of the month, that's the analysis. No, right? So that can't be just the analysis, right? Your success needs to be more detailed than that in terms of looking at your trading, right? So the results, the data, okay, in this sense, the mechanical approach, okay, because you can analyze the mechanical approach better than a discretionary approach, because there are rules based on mechanical approach. That's why you can measure results better if you're using a mechanical approach. Basically, you know what you're doing. When you're using a mechanical approach, you can measure and review, okay, and crunch the data that comes out from your approach, and you basically know better what you're doing, right? That's why I highly recommend a mechanical approach in terms of looking at the trading methodology, right? Okay, so now let's talk about trading and investing. So, I've been using this word trading versus trading more than I'm using this word investing, right? And I think a lot of people in the Malaysian stock market love to trade, right? Okay, a lot of them invest as well, okay? Some passively through the fund managers, okay? But when they get their hands active in terms of wanting to do calling the shots in terms of the stock market, a lot of you guys out there are trading, okay? And I understand that. I love trading as well. I'm a full-time trader, right? So investing, of course, is very different. So you need to approach investing and trading in different mindsets, okay? Because in terms of investing, you're building wealth over an extended period of time, okay? And the strategy is to buy and hold a portfolio of investment assets. Okay, so in terms of investing, if in the stock market, if you're getting returns between 10 to 15% annually, that's extremely good results. Okay, of course, a lot of traders will say no, right? So that's why a lot of Malaysians are traders, because they're more aggressive than that. Okay, so in terms of trading, trading will be buying and selling stocks with the goal of generating returns that outperform the investing. Okay, outperform buy and hold strategies. That's why you love trading, right? Okay, so in terms of investing, it's long holding periods. Okay, trading is the shorter trading periods, right? Trading, can be like intraday. Some of you love day trading. Okay, when of course, if the environment is good for day trading. Okay, some of you may trade. Last time we call it contra, but it's basically intra-week. Basically, you hold for a couple of days, and some may hold a position trade even for 1 or 2 months. Okay, in terms of trading, but investing, you're talking about holding a stock for a longer period of time. Okay, so in terms of return expectations, we've spoken about that. So that is the difference in trading and investing. All right. So in terms of trading, right, you will require more skill compared to investing. Not to say that investing does not need knowledge and skill, it does, right? But in terms of trading, you need to be even sharper than that, right? Because you are more actively involved in the market, right? You're buying and selling more actively than in investing, right? So those are the distinctions that you need to make between trading and investing, right? So when you talk about shorter term trading, we can basically talk about these few types, okay? Day trading or short-term trading, okay? Or position trading, some people call it swing trading as well. So for the shorter term one, people can trade between intraday, that means go in and go out within the day, okay? Or 2 to 5 day period, okay? The 2 to 5 day period seems to be quite a favorite as well, right? This basically, in terms of the strategy, you are trading some specific news events, okay? It could be earnings, or it could be some political economic events that may impact the stocks that you trade, okay? So this move is maybe a very big move or an expected move for the short term, right? So for those day traders and short term, they will look for stocks of that characteristic, okay? So in terms of stock selection, okay, it could be current volume leaders, okay? It could be the stocks that have rising volatility, right? So if you're using a chart, okay, as I do, I use charts and technical analysis, then your chart time frames for this type of trading will be 15 minutes or 60 minutes, right? So for day trading, 15 minutes will be the types of charts that we're looking at. And for the shorter term, between a 2 to 5 day trading period, you may be looking at the 60-minute chart. In terms of position trading, when you're looking at a medium-term 2 to 4 week holding period, okay, then it's a different thing, right? You are trading for capturing a larger price trend, okay, or a swing in the trend, right? When it changes trend, right? So your stock selections are stocks with clear trends currently, or stocks that are making a trading reversal or market direction change, okay? And we have covered this topic in terms of identifying a trend and trading when the market is turning for reversal. We have covered that in our previous series, right? So later I'll show you that title, and you can go back in terms of looking at what are the strategies for that types of stocks, okay? And when you're doing that, usually you're using the chart, which are daily time frame, okay? So for trading a more position type trading, holding for maybe 2 to 4 weeks or slightly longer, okay, you are basically looking at the daily charts. Okay, so in terms of looking at the technical analysis, you will be going into the daily chart. All right. So for investing, can you use charts for investing? Okay, later we'll talk about that. Yeah, of course you can use charts for investing, right? Okay, so in terms of investing, if you are utilizing charts, you may be using daily or even weekly charts. Okay, because you're holding for the long term. All right. So charts are very helpful for that as well. All right. So your trading plan needs this very important thing, okay, which is you need to keep it simple, okay? Simplicity wins over complexity, okay? So as part of my work also, I design trading systems using algorithms, and one of the measures of whether the algo or the trading strategy is good is whether it's the rules that it generates is simple, okay, and not very complex rules, because the robustness of a trading system is the simpler the rules are, the better for the longer term, the more the stronger and more robust it can, it can perform, right? So in terms of complexity, if your rules are very complex, you will make trading decisions very difficult, and then sometimes it'll be very confusing when you need to make so many complex decisions to come to a decision to trade. Okay, so simplicity wins over complexity. Of course, it needs to be logical and rational. Okay, you have clear rules for stop losses, for entry and for exit, and the most important thing is your trading plan or your methodology needs to have a positive expectancy, and this what I want to expand on afterwards. Okay, I will show you a way to know why and understand why expectancy is very important. All right, so keep it simple. Okay, always keep your trading plan as simple as you can get it to be. Right. So in terms of market analysis, okay, there are so many things in the market, which one to use, okay? And what I show you here, all these are already the stuff that I've gone through myself, that I've learned myself, okay? So you say, you can use economic data, you can use things like candlestick and analysis, so Fibonacci, WGAN, astrology. I have clients that you use to trade astrology, the moon cycles and all that, okay? So many different things, Elliott wave, Dow theory, pattern, stats, price action, ratio, black box. Wow, I tell you, these are everything that I've learned over the years, okay? So I can tell you for sure that you really need to simplify everything, okay? I'm trying to make decisions based on all this information, you know, it's going to be an overload, okay? So when you actually look at market analysis, you are basically opening up. There's so much available, so much choice, okay? So spoiled for choice, okay? But as I say, the key thing is make sure the strategy is whatever you use is simple and robust, logical and rational, okay? So market analysis is really like a box of chocolates, right? So in terms of looking at that, of course, market analysis falls into two very big categories, which is fundamental analysis and technical analysis, okay? So can both of them be used together? Yes, they can be used together, of course, okay? But in terms, if you're trading the shorter term, if you're trading, say, the day trading, or you're trading for a trend in the next 2 to 3 days trend, then fundamental analysis may not help you as much as technical analysis, because technical analysis can give you the timing, okay? Timing when to get in and get out, okay? Whereas fundamental analysis, as you can see over here, it focuses on qualitative and quantitative factors, which are slower to develop, right? Corporate results, financial statements, all them come out on a quarterly basis, okay? Economic data may come on a monthly basis, but these are, in terms compared to technical analysis, which is the analysis of price, behavior, and volume, tends to be less reactive compared to technical analysis, right? So among the shorter term traders, the favorite, you can see that a lot of them use technical analysis, right? We need to react very fast to the price and the action in the market, right? So in terms of longer term investing, the fundamental analysis, of course, is very, very helpful, right? It gives you the background of the company, how they are doing, okay, their profit record over the number of years or over a number of quarters. These are important things as well, right? So for those who are even trading technical analysis, of course, when you're picking your watch list for the stocks that you're trading, of course, you will look at that this particular stock is fundamentally sound as well, right? So in terms of using between fundamental analysis and technical analysis, a lot of traders use technical analysis for because they're trading the shorter time frame. Okay, they're basically trading shorter time frame. That's why they choose technical analysis, right? So now, after you decide to trade, the big second challenge you come up is what stocks to trade. Okay, there are so many stocks on Bursa Malaysia. Okay, which one to trade? Okay, so you will need to build yourself a watch list. You cannot watch all the stocks, right? So you need to build your watch list. Okay, and what are the criteria? What are the considerations when you watch for a watch list? Okay, or put stocks into your watch list. The first, for me, okay, volatility is very important. Okay. you need to buy a stock that moves, right? So who wants to buy a stock that doesn't move? Okay, nobody want to do that, right? So price movements and fluctuations are very important because volatility equals opportunities. Okay, so it's very important to measure. So how to measure a stock that has volatility? Okay, we'll show you some ways to do that. Liquidity. Why is liquidity very important? Okay, you need to have enough buyers and sellers participating. Okay, so basically is if you are going into the market, you must be able to get out. Okay, if you go into a stock that you cannot get out, there's no liquidity. Okay, when you want to get out, there's no buyers, then you are in a problem. Okay, so liquidity is one of the very important considerations. Okay, and of course, an amount of capital required to trade, which means that if your capital is smaller, then you may not be able to buy the heavier or more expensive stocks. Okay, so that is one consideration as well in terms of building your watch list. Right, but these are the very important ones. Let me expand on it. Okay, so excuse me. Volare. Okay, for those who are fans of the Gypsy King, this is one of my favorite songs. Okay, one of my favorite songs from this group of guitarists and singers. Okay, basically, in terms of looking for your watch list, you need to look at volume, volatility, liquidity, and range. Volare. Okay, just to jog the memory. Okay, so basically, what's volume is how many shares traded per day, of course, you know that. Volatility is how much the stock price swings, okay? Liquidity, of course, we say ability of buyer and seller so that we can get out, okay? Get in and get out as well, okay? And range is how much, the range of daily, how much is this stock moving, the difference between the high and low of the stock of a certain period, okay? So these are things that you want to make sure that you put as a criteria for your watch list. Okay, so remember this Volare, right? So volume, volatility, liquidity, and range. Okay, so let's go in a bit deeper. So volume, of course, refers to the number of transactions on a daily basis. Okay, so what could be a good consideration? You may be looking at stocks above 1 million, active stocks above 1 million shares traded per day, right? Liquidity, of course, refers to the ability of the buyer and seller, availability of them to enter, for you to enter or exit the market easily, okay, without impacting prices, of course, right? So the bid-ask spreads of a certain stock and the volume is very, very important. It's related, okay, in terms of that. Okay, so if you look at blue chip stocks, of course, blue chip stocks, you will expect them to have sufficient liquidity, right? Yes, okay, and volume, yeah, but not always, right? So it depends. Certain times in the market phase, even blue chip stocks may not have sufficient liquidity. So you will need to be able to monitor all these things when you put into the watch list, okay? So penny stocks, what about penny stocks, okay? The penny stocks, of course, you see a lot of price surges. A lot of people like penny stocks because it seems to be cheap and moves, really moves, right? Okay, but important consideration as well is although you may have surges in volume, but these stocks have enough liquidity when you want to get out. Okay, so this is a very important consideration as well. Okay, so you want to take a profit or you have a stop loss. This could be difficult to implement or execute without excessive slippage. I mean, slippage is basically your prices go out. Okay, so your intended price slippage is those what do you call that? Things that happen, bid-ask offers that make it so that you can't execute the price that you want. Those are the slippage, right? So in terms, if you are even seriously looking day trading, then active volume and liquid stocks is an absolute must, right? So these are the key criteria that you will need to put into your watch list when you want to screen for stocks, right? So let's move on. Volatility again, okay, why is volatility very important and how do you measure it? Okay, this is the key to your profitability, all right? Because you bought a stock that doesn't move, then the problem already, right? So it's basically your capital is sitting there not working very, very hard, okay? One of the popular ways that the stock market people use is beta, of course. So what's beta? Beta is a measure of volatility against the index. Okay, so basically measured against the FBM/KLCI, which is the main benchmark of market performance, right? So a beta, if you look at the stock, beta is above 1. That means it's more volatile than the index. Okay, because if you are 1. Then you're following the index almost exactly, but you're above 1, that means you're more volatile than the index. If it's below 1, okay, that means your stock is less volatile than the market, right? So if you pick a stock that is 0.8, okay, less than 1, then your stock will move less volatile compared to the benchmark FVM KLCI. Right. So depending on your individual risk appetite, okay, so whether you pick what type of volatility, okay, you must pick something that is comfortable to you, right? But of course, always pick a stock that moves, okay? So in terms of a stock that moves, then you need to look at this particular measure called range, okay, which is measured usually using this technical indicator called average true range, ATR, okay? And this measures the volatility of a stock. So basically it measures on, say, if you use a ATR for a daily chart, then for the daily expected average, the range is how much, okay? So that will tell you the movement, okay? So let's say, for example, if the ATR is 5 cents or 10 cents, what is saying that on a daily basis, this particular stock, okay, moves either 5 cents or 10 cents. Okay, so the average can change, of course. Okay, but usually a lot of traders use ATR to measure what sort of movement can that particular stock move. Okay, so for example, if you have a stock that is 1 ringgit, okay, and the ATR is 5 cents. Okay, so basically a stock that is currently at 1 ringgit, ATR of 5 cents, that means it can move about 5% averagely over a day's period. Okay, so that's how you gauge the range using the ATR. Okay, so typically in terms of the technical analysis, ATR is used, 14-period ATR is typically used. Okay, so that's volatility and range analysis. Okay, so when you build your watch list, you through the wonders of technology these days, okay, and you have to, of course, use a stock screener, right? You have to put in your criteria and then screen those stocks, and then pick those stocks and put into your watch list. Okay, okay, so 10, 15 years ago, you had to pay a lot of serious money for stock screeners. You had to subscribe to the service. Nowadays, it's free, right? So you can get it. Some brokers provide you with facility to do that. Some of the systems have stock screeners, right? You have a lot of online websites that can use the stock screeners as well. Okay, so your selection to pick the stocks to build your watch list, okay, we use a market or stock screener, okay, basically to shortlist a selection of stocks with your criteria, which is volume, volatility, liquidity, and range, okay. But of course, I would have to say again, if it is advisable to be familiar with at least the stocks that you are picked for your trading, okay, you must need at least have some idea of the stocks or the sector that you are picking to trade, okay. It's better that way, although some people may say it's not absolutely necessary. Of course, technical analysis is supposed to tell you everything, right? But it's better to know something about the stock you buy and sell as well. All right, so in building a stock list, let me show you a sample over here. Okay, this is what I did using a free online stock screener, okay, from investing.com. Okay, so they have a list of the Malaysian stocks as well. Under, in fact, you have a stock screener for the whole global stocks. Okay, I can use it for Malaysia, and this is the criteria I applied to come up with this list. Okay, so basically the filter is the market cap more than $500 million ringgit. Okay, the volume, daily volume is more than 1 million, average 3-month volume above 1 million. Okay, beta above 1.1, and ATR more than 5 cents. Okay, so once I press this screener, it gave me this selection of stocks, and this was on 24th of May. Okay, at this time was about the afternoon 3:50, and this is what it came out. Okay, so with this particular list, there's a function in this screener that I can also see the strength of the technicals. Okay, so what I do is basically once I have the list of these stocks in the watch list or the screener, they already shortlisted, then I will go into the technical performance, and I will see in terms of the technical indicators, okay, in terms of 15 minutes, hourly, daily, weekly, and monthly, and sort them under the strong buy. Okay, so you want, although they meet all these criteria, the filter, okay, so I want to trade only those in the uptrend. Of course, you're buying stocks, right? So those that are in strong sell or neutral, I will ignore, okay, for the timing, depending on which time frame you're trading. Again, where are you trading 15 minutes, hourly, daily, or weekly charts? Okay, so in terms of you have to determine your trading style. Okay, so in terms of that particular time, Boston Plantations had the the strong buy for all categories. Okay, so hibiscus in this particular sample, when it came out in the filter, was strong buy for daily, weekly, and monthly. Okay, so basically the longer term. Okay, so this sort of gives me an easier way. So from here, once I see this short list of stocks, then I will use this and go into my technical analysis and software and my methodology and analyze this list of stocks. So if, let's say, for example, I'm interested in trading the daily chart, okay, so I'll basically take the top 5 of this on top of the list and go in and analyze for the entry and exits. Okay, so what the watch list and the stock screener can help you to do the tough work, okay, of finding the particular stock to put into the watch list. Okay, so do use technology and do use a stock screener, okay, to really pull down the stock selection, because there's just too many stocks, in the market. Okay, even our Malaysian markets has close to 1,000 stocks to pick. All right, so use a stock screener to help you out in this very tough work. Okay, last time it used to be tough work, which stock to buy is a big headache. Okay, so if you have a systematic way to reduce and filter down to these stocks, then it'll make your work much easier. All right. Right, so we spoke about this, what time frame to trade. Just now you saw already the different time frames, okay? So you already know that 15 minutes is good for day trading, 60 minutes for intra-week, and daily charts for trading trends, 4 weeks or and above, right? So those trading styles you will have to adapt for what time frame you want to trade, okay? Which goes back to the first question, is what time can you commit? How much time can you commit in terms of trading? Okay, so that will determine whether you can trade 15 minutes, 60 minutes, okay, or you prefer to trade daily charts. All right. Okay, so in terms of setup, trade, exit, okay, the golden rule and the most important rule in terms of trading entry and exit is it's the most important part of your rules, okay? Because in terms of a very famous quote in terms of the stock market is, the money is not in when you buy, okay? Anybody can go in and buy a stock, right? It is when you sell, okay? How do you manage the trade, okay? So in terms of, just now we spoke about commitment of time to managing a trade, okay? Once you're in, how do you manage the trade, okay? Whether you're putting trailing stops, okay? If you're trading day trading, maybe putting trailing stops and all that, that takes time. Or if you are someone who trade daily charts, then you come back after your work, during the evening, you analyze it, okay? So those are the times that you actually go in and manage your trade, which is managing basically your exit, okay? So some traders have said that a monkey can enter a trade. Any monkey can key in, right? Just press buy. But money is made or lost when the exit comes, okay? So whether you exit as a stop loss, whether you exit for profit taking, or whether you exit if the trade's not going anywhere. So you somehow bought a stock that you thought it was active, but then when you went in, it didn't go anywhere. Okay, it's very important as well, okay, to have exit strategies for all these 3 different scenarios. All right, and of course, the most important exit of all is your stop loss. And this is one of the money management and risk management rules that you need to have, okay, put into place every time you trade, okay? And if you go out today and they don't, you can't remember everything I've said, please remember this particular slide, okay? Do not trade if you do not have a defined stop loss strategy. This is very important. This rule itself will have saved a lot of people, okay, from deep losses, okay? A lot of people say, you know, the stock market is, everybody lose money in the stock market, okay? Yeah, you will lose money in your stock market if you don't understand this particular slide that is in front of your screen now, right? if you trade without stop losses, you don't have what do you call that, airbag. Okay, you drive, even all your cars these days are equipped with airbag, mandatory, right? And trading, okay, when you put yourself into a financial risk and you don't have any protection, okay, basically what does a stop loss do is basically gives you the protection. Okay, protection against what? Okay, it's basically protection for your capital, right? Because you have to be practical. Okay, not all trades will be winners, right? And the market, not all times are bull markets, right? So you need to have this stop loss to preserve your capital when the winners come, right? So, you know, you can't be losers all the time. Of course, if you catch a wrong phase of the market, of course, it can be wrong because it's a systematic risk, right? Right. Like the COVID-19 pandemic, when stocks really took a nosedive, that's a systemic risk. Okay, all stocks went down, so that can be helped. Okay, that can be helped. Other strategies called hedging and all that. Okay, but not through stock selection. Okay, so you need to have a stop loss that will preserve your capital so that you can come back into the game again when the market comes back. Right. So every time you trade, immediately you put in a stop loss if your system can permit that. Okay, or you put instructions with your brokers to say that if it's reached this price, then please alert me, I may want to get out. Okay, so it's very important. If you can put a hard stop loss in terms of putting in a system, that's even better. Okay, so have that, know that, and you know where your stop loss is before you actually go in and trade. Okay, it's very, very, very important. Okay, I can't stress this particular slide. You can call me Chong Hei, long-winded or whatever. Okay, if I bug you on everything, I will bug you on this particular slide. Okay, so different types of exit stop loss as well in terms of fixed dollar, percentage, technical stops. These are basically in terms of your money management strategies, what type of stops you use, right? So I personally use both fixed dollar and technical stops as well. Okay, depends on the signals of my charts. Okay, there is a quote, okay, by Victor Niederhofer. Okay, and this is a very good book that I recommend you to read, The Education of a Speculator. And this guy traded with George Soros. And during his time when he traded with George Soros, he was saying that 10 years with George Soros, you know, I've never heard him speaking about winning trade. Okay, to hear him talk, you think he had nothing but losses. Okay, so even George Soros don't only talk about his losers, right? He don't boast about his wins. Okay, but conversely, listening to the biggest losers, Victor said, the biggest losers are the ones that talk about the big wins and never talk about their losses. Okay, so that's the contrast between a winning trader and those traders who are not successful. Right, so stops can make the difference between a successful or not successful trader. Okay, so in terms of profit taking, of course, yes, you need to have a systematic way to take your profits so they can fight the emotions of greed, as is the main purpose. Okay, and it's also a way to achieve your consistent result. Okay, so if you are day trading, then you really require you to be able to consistently, of course, day trading is smaller profit targets, okay, to be successful, okay, not to be too greedy when you're day trading. Remember to be able to take your profits, okay? So the different types of profit take exits, so you have the fixed dollar, you have the percentage of price, you have the technical stops, which is triggered by your charts, okay? And of course, you have trailing stops, okay? This is a very useful stop, okay? What is a trailing stop, okay? For those who are new, a trading stop basically is as the market goes for you in terms of your profit, you will slowly bring up your stop losses. Okay, so that one, if, let's say, for example, the market moves up and then when it comes down to a certain percentage or fixed dollar, then you'll be out. Okay, so basically you try to maximize the run of the trend that you have. Okay, so trading stops is a very, very useful way of protecting your profits. Okay, so for those who want to look at technical stops and how we place technical stops, okay, we had this session called the High Probability Trading Strategies for Catching Early Stock Trends. You can, I think, check it out in the YouTube channel, Google for this, or you could, LiveChamp, we probably can leave you a link as well to in this video for this session that we had previously. All right, so that is methodology and how to catch. It's very interesting session for those who didn't join us during that session. Please do look out for this particular session and see how you can trade the strategies for catching early stock trends. Okay, so we move on. Okay, let's talk about numbers now. okay, knowing your statistics, okay, it's very crucial, okay, and without numbers, you're basically trading blind. That's why I basically very highly recommend that you trade a mechanical approach, okay? And professional traders know their statistics, okay? A lot of professional traders monitor their results, okay, of their trading methods, okay? And a lot of them test out these strategies before they actually put money on it, okay? So the key question is, what is your trading edge, okay? What is your trading edge, and how do you calculate whether your system or your method has a trading edge? Okay, so let's have a look. Method of finding your edge. Okay, how do we do this? Okay, the key thing is looking at whether your trading system has a positive expectancy. Okay, positive expectancy denotes that what you can expect to earn on average for every dollar that you risk. So if every dollar that you risk, there is a positive return, then your system or your method has an edge. Okay, so there are 4 variables to calculate this expectancy. Okay, so you need, of course, you need data. And again, if you don't have data, then you cannot calculate your edge. Okay, so that's why I'm a bit long-winded about mechanical approach to trading. Okay, so numbers of winning trades. Again, you need to track the numbers of winning trades. You need to track the numbers of your losing trades. Okay, then you look at what is the average profit per winning trade and what's the average loss per losing trade. Okay, these are the 4 inputs you need to use to calculate your expectancy. Okay, so let's move on. So in terms of expectancy, here's an example, okay, how we calculate it. This is the formula over here in bold, okay. E equals to 1 plus win divided by loss. This is the average win and average loss multiplied by the percentage winning trades, okay. Okay, so this is how you do it. Let's say, for example, you have an average win of 2,000 ringgit, an average loss of 1,200 ringgit. So your percentage win, okay, is 0.52, okay, slightly more than 50%, right? So you plug that into the system, and the system gives you a 0.387 expectancy. So this is positive expectancy. So thumbs up, this is good. Okay, you have positive expectancy that means for every dollar you risk, you have a return of 0.387. Okay, so this is very, very good. All right. So if you plug in and your numbers, let's say in the next one, okay, you plug in these numbers. Now you have a system that gives you an average win of 1,000, average loss of 1,000, and you win half the time only. You lost half the time and you win half the time. So is this a good system, you want to ask? Okay, so you plug in the figures, okay? E equals to 1 plus W over L times P minus 1. So what do you get? You get 0, okay? So this is a system that if you have a system that average win 1,000, average loss 1,000, and you only win or lost half the time, then you are basically wasting time. Okay, you are losing time and losing the capital returns on your capital that you have got if you invested in something else. Okay, so this is very important to analyze. Okay, whether the system has this 0 expectancy. Don't waste your time because you trade until 100 years or so, nothing will come out of it. All right. So the next one is example number 3. Okay, okay, average win 1,000, average loss 2,000. Percentage win, wow, now higher, 0.6. It can be better than 50-50. So is this a good system? Oh, okay, plug the numbers in and you get what? You get minus 0.1, negative expectancy, right? So what does negative expectancy basically tells you? In the long run, every dollar you invest, you'll be losing money. You're not getting a return on your money, right? So, okay. And please look at this and tell me whether this is familiar. Is this a familiar figure? Average win 1,000, average loss 2,000. Actually, sadly to say, a lot of people trade a system that has this kind of numbers, right? So because it's very natural for people to quickly take their profits, and then when the losses come, they'll continue to hold. Okay, you may have heard horror stories of people who have held the stocks for 10, 20 years, okay? Held from don't know what price until now almost nothing. Okay, so how do you recoup? How can you be successful if you trade a system like that, right? So if you're trading a system that has this type of expectancy, basically guaranteed to lose money, right? So don't do it. If you have a system with this kind of numbers, don't do it. Okay, yeah, it's better to keep your money, let your money be professionally managed rather than be a trader. Okay, so that's the harsh reality for you. All right. Okay, so in terms of data, you need to keep a trading log. Okay, so these are the things that you need to keep. Okay, I won't run through it too much. You can go through this again, but things to record, of course, when you enter, when you exit, quantities, code, okay, where you put your stop loss or the entry price. Okay, and after that, exit price, gross profit, after net of brokerage was a net profit. Okay, you need to also calculate your equity, that means your balance, okay, and to see your system, what's the drawdown. Drawdown basically, if it loses money, when does it recover again? Okay, so all these are numbers. If you check in the internet, you will have those definitions for this. Okay, and these are very important. Okay, when you keep a trading log. Okay, so keep your statistics for and analyze it after 50 to 100 trades. Okay, if you can have 50 to 100 trades, that will be a good number of trades. And then you analyze what is your net profit, what's the winning percentage, okay, what's your average win, average loss, and you calculate your expectancy. Okay, so this is very important, and it's more easy to keep the data for a mechanical approach. All right. Let's move on. Okay, testing and evaluating a trading system. Obviously, all those numbers you need to have, but two crucial measurements is the win percentage. Okay, and a lot of people tend to spend too much time on this win percentage. Okay, looking for a system that Holy Grail gives them like 75%, 80%. Okay, those systems are very rare to come by. Okay, be careful of a person that offers you that kind of statistics, because if I have that kind of statistics, I will keep the secret very close to myself. That would be a trade secret that nobody wants to share with you, right? So if everybody willy-nilly shares with you, oh, my system 95% accurate, you know, wins 95% of the time, there is the other thing that he is telling you, and most of the time they never tell you this particular crucial measurement, which is the win-loss profit ratio, win-loss ratio, average win over average loss. This is something that we probably won't let you know. Okay, so don't concentrate only on the winning percentage. Also know that system's win-loss ratio or profit factor, the gross profit over the gross loss, is very important, right? So no point having a very high percentage of wins, but then when you lose money, you lose a lot. When you make very little. Okay, so that doesn't make sense, right? So if you have those numbers, you're able to calculate the expectancy of the system, so you know whether this system can work or not. Right? So these are very, very important considerations when you're. Okay, so money management, okay, very important. I give you a few guidelines. Okay, the first thing is, as we said, always preserve capital. There is always a time with the market that will come and you'll be, what do you call that? You are able to trade profitably. Okay, so this is the key to your survival in terms of your trading, and also the key to your prosperity. Okay, always trade with a stop loss. You need to have your airbag. Okay, whether you're driving or you're trading, you need to have your airbag. Okay, risk no more than 2 to 5% of your trading capital on any trade. Okay, so this is a money management rule that has always been used. Okay, and also a position sizing rule that a lot of people use, the professional traders use. Okay, so always calculate your win-loss ratio. Aim for a win-loss ratio of 2 or more if you can, or a profit factor of 1.5 or more. All right, so use position sizing. Increase your size in terms of when your profits, you build your account size bigger, then you need to also trade a position size that is commensurate to the size of your account, right, to maximize the returns, right? So in terms of capital, let's talk a bit about capital. Okay, when you talk about the professional trading, okay, if you want to approach trading professionally, not necessarily in the sense of a full-time, but you're doing it like a professional, then you need to treat it like a real business. Okay, needs to manage like a real business, right? So even if it's a part-time business, okay, trading may be part-time for you, you do it after your work, it's still needed to be treated seriously, right? So in terms of capital requirement, okay, in terms of capital requirement, if you're trading part-time, of course, different from a full-time basis, okay? So a lot of people say that, oh my, I love trading, I want to be a full-time trader, okay? So the key question is, do you have the capital required, okay, to risk and also have the reserve funds? Okay, a lot of people forget, you know, if you want to have a full-time trader, you don't get your success immediately. You know, even when I retired to become a full-time trader, I don't immediately, get the success that I want. It takes a bit of time, right? And usually it's between 1 to 2 years, okay, where your strategy gels and you know yourself better when you're full-time trading. Full-time trading is different from part-time trading, obviously, right? So you have things like operational cost, space, charting software, but the most important thing is time and income that you are not having when you are on full-time basis. If you are relying on trading as a full-time income, okay, and say you left your job, okay, you bought into the hype of kicking your boss out of your life, right? So now you are full-time. You need to have at least reserve funds for 12 to 14 months. Who's going to pay for your car? Who's going to pay for your house? Okay, who's going to pay your kids' education, stuff like that. So remember, if you're really going full-time, okay, you need at least two years or 12 to 24 months of reserve fund, okay? If you're trading, don't immediately give you the results, okay? So this is very, very important. Okay, I want to emphasize this, okay? Whether you're full-time or part-time, scared money, okay? What is scared money? Okay, money you cannot afford to lose, okay? Or money that you must mentally, that you cannot, what do you call that? You cannot afford to lose, okay? So because when you trade, you must be mentally prepared to lose it all. If you don't have that kind of frame of mind, or your capital just cannot lose one, okay, you are in deep trouble, okay? Nothing can help you, honestly. In terms of trading psychology, nothing can help you, okay? Fearful money is a guaranteed way to lose in trading, okay? There's no other guaranteed way than fearful money. Okay, so money that you borrowed just to try to make a killing in the stock market, or it's the same as basically when you have that kind of frame of mind. You're basically just like going to a casino. You're treating the stock market as a casino, and I can guarantee you, most of the time, you will lose it all. Okay, so you have to ask yourself, can you walk away from a loss? If you can't, this money, I cannot lose it because it's my children's milk money. I lose it, they can't drink the milk. Then I think perhaps not the right time yet. Okay, you need to save up some reserve funds. Okay, so that is a very important consideration. Capital. This trading and investment is all about capital, right? Okay, so the other thing is drawdowns. Just considered in terms of when you're trading, your equity curve or your balance doesn't move up in a straight line, right? So yes, it's ups and downs, ups and downs. So long as the curve, your balance curve is going upwards, then you're on a good track, okay? But drawdowns, you have losing streaks as well, okay? You don't win all the time. So markets may not be conducive to trading at a particular time. So, you need to be able to handle these losing streaks, okay? So, and that's what differentiates between the good traders and the ex-traders, okay? All right, so you have the picture of the very famous Warren Buffett, okay? And he says this: when you come to making mistakes in the market, it's good to learn from your own mistakes, but it's better to learn from other people's mistakes, okay? From the man himself, okay? So yes, financial mistakes, try to minimize it and try to learn. That's why you need the knowledge, okay? I really emphasize you need to have the knowledge and you need to hone the skill. After you know the knowledge, you need to practice and hone the skill, right? So that when you make mistakes, it's not costly mistakes, right? Okay, so from learning from others' mistakes, I will want to show you something. These are top 10 reasons why 90% of the traders lose money, right? So let's quickly go through them before we go into Q&A. Okay, the first is not knowing the difference between long-term investing and trading. Okay, so this is something that I've seen a lot of people do. They start with trading, then end up long-term investing, basically holding a lot of stocks that they lost money because they didn't have a stop loss. Okay, holding those stocks for tens and 20s of years. Okay, so this is very important. Okay, if you're long-term investing, you need to have a different strategy, of course, and trading is a different strategy. Okay, the second is underestimating the risk. Okay, and sometimes if you use leverage, let's say for example, if you're using margins, okay, then you need to understand the effect of this. Okay, and a lot of people underestimate the risks. Okay, that's why they don't have to stop. They feel that they cannot lose it all, but That's why they underestimate the risk. Okay. The third is the deception that trading can look so simple. Okay. So in 2020, a lot of people learned this very tough lesson. Okay. Wow, stock market so easy. Go in, buy this particular sector of stocks, then you are sure to get rich. Okay. A lot of people had brief glimpses of glory. Okay. They were rich for short term. Okay. And then after they lost it. Okay. So I have seen this in the last 25 years in my business. I've seen it. Okay. I've got clients that, in the morning at a few thousand ringgit, and at the end of the day had 100,000. So, wow, it feels great, right? It feels like, wow, so simple only. Then they start to extrapolate. Okay, if I can do this every day for next 100 days, I'll be a multi-millionaire. Things are not that simple. Okay, don't fool yourself, right? Deception. Don't fool yourself. Okay. So number 4, no training before trading. Okay. So no skills, no knowledge. Okay. Hoping for trading success. Okay. Hoping. That's the word, hoping. Right. So this is one of the reasons why people lose money. Okay. Starting off undercapitalized. We already spoke about the importance of capital and why you cannot have capital that you cannot afford to lose. You need to have real risk capital, which flows to the next point. You need to use money that's actually truly risk capital, okay? Because that works on your mind. That's the thing that works on your trading psychology, right? Overconfidence, okay? This is a beginner's mistake. So simple only, last 3 months, I made that much, okay? And sometimes people promise you that much. They feel that system can do this. They have overconfidence, okay? They have not put in the required amount of work, okay? So always think back, have you put in the required amount of work, okay? 8, wanting to be right instead of making money. Some people trade with the ego. Okay, so so when you go in the stock and then you tell all your friends why you're on this stock, okay, the more you invest in your ego in terms of telling the whole world you hold this particular stock, it's very difficult, because once you are wrong, you cannot backtrack on your words. You see, you have to climb down from your pedestal, and a lot of people cannot do that. They want to be right, and that, but markets always prove you wrong. You always trade the market with a lot of humility. I do that, a lot of humility. Right? Listening to OPPO. What is OPPO? Other people's opinion. Okay. Basically, news, rumors, CNBC or whatever, social media, things that flow around all the time around. Okay. And not doing the analysis, basically wanting to take the easy way out. Okay. If everybody can be reached, okay, just listening to news, rumors, and social media, a lot of people who have done that already. Okay. So it's not the key. Definitely listening to OPPO is not the key. Right? You can put it in the watch list. Okay, if your stock, you can put in your if you can screen it, you can put it in your stock list, and then you need to analyze it. Okay, not to say that some of this news not good, but you got to take the news and you got to analyze it. Okay, just don't take it, at face value. Right? Trading for excitement, wrong reason. Okay, we already told you that you need to trade seriously as like a business. Okay, no money management, no risk control. Okay, no stop loss is a problem. No methodology. I recommended a mechanical approach. Okay, so if you are the field trader, okay, unless you are very talented, okay, since day one, you're born to trade. Some are, okay, I'm not saying they're not. Some are, okay, but 99.9% are not. So have a method, okay, have a methodology. Have trading rules, okay, or having trading rules that you won't follow, okay, so no point, okay, that's a discipline, right? That's basically discipline. Having unrealistic expectations of your trading returns, okay? So when you're first starting out, your skills not that great yet, okay? So your expectations, you need to temper those expectations, okay? Over trading, this a lot of people do, okay? Silang, I fight with the market, they put in all their money, okay? They sell their car, they go and mortgage, they sell everything and put in the market, okay? Not enough lagi put inside, but over trading, taking too much risk. Okay, basically when you're taking too much risk, that means you're above your risk capital already. You're already way above your risk capital. Okay, no discipline, no patience. Okay, seeing trading as a hobby and not a business is a serious one. You need to just hobby. Some people are not serious about their hobby, right? Some are, but a lot are not. Hobby is hobby lah, it's pastime only, right? So you need to see it as a business. Okay, trading without plan, needless to say, and trading on hunches. So this is starting out. They say, I feel you. Always catch yourself. If you feel that you are making a decision with that thought, I feel can go in now, you are not using a good system. Okay, that's what I want to say about this right? So these are the top reasons why a lot of traders lose money. Okay, so we can learn from these mistakes that people make. Okay, try to avoid it. Remind yourself all the time of all these 20 big mistakes. All right. So in terms of looking again, we started with Shunzi. I want to end with Shunzi as well. How do you secure yourself against defeat? Basically, you need to put yourself beyond the possibility of defeat. Okay. So the good fighters of old, Shunzi said, must put themselves beyond defeat. And that means your strategy, you yourself as a person and all that, you must be solid. Okay. Then you wait for the opportunity of defeating the enemy. That means the market will give the opportunities to you, right? So first secure yourself against defeat, and that lies in your own hands. Okay. Your knowledge, your skills that you acquire, your study, your backtesting, your data that you collect. Okay. Those are investing in yourself first. Okay, and then you go out in the battle and fight. And then if you're good and prepared, the market will give you your profits. Okay, that means the enemy will be defeated, right? So very important statement, or very important chapter in terms of Sun Tzu, The Art of War. And I want to leave you with this thought on Sun Tzu, and we will go into Q&A. So back to you, Shane.
Wow, thank you so much, David. That is a very compact, intensive session, definitely coming from a very veteran trader. So yes, thank you so much for sharing with us your knowledge in terms of trading and investing. All right. Okay, if you like the session, maybe you can give us yes. Okay, stands for you like the session. Okay, so let me know if this session was has been helpful to you. So in the meantime, if you have any questions, please write in the Q&A while we will attempt to address it within the next 5 minutes. Oh, wow, cool. I think a lot of people send you a massive amount of love. Okay.
Thank you.
Yeah, phenomenal. Thank you so much. So next, time for our little question and answer session. Wow, can't get enough of David Loh. So yeah, we must sign up for
Ask
other
Bursa to
session
organize
with
more.
David Loh's session. We still have about a couple of sessions left with David for the rest of the year. All right. So first question is, what are the stock screeners that are freely available? Can you share some?
Okay, one of them which I use, which is quite useful because some of the functions, it depends on the functions. Okay, I use investing.com, which is a free one. Okay, but be careful as well when you go into investing.com. There's a lot of this advertising. So if you ignore the advertising, okay, you go in and sign up for it. And the one you saw just now, which I flashed on the screen, is from investing.com. Okay, one thing good is I can integrate not only the fundamental analysis, but I can also look at the technical analysis as well. So it's got the function for technical analysis. So some stock screeners online, some are fundamental based, right? Talking about earnings, ratios and all that. Okay, some have both. Okay, so if you have one that's both, that'd be great. Okay, so you can even go into, I think KLSE screener, I think has got a screener as well, right? Like its name. So just type in screener, stock screener for Malaysian market, and you get a whole host of them. I don't know whether Yahoo still has it. Okay, I used to use Yahoo, but I don't know whether it still has that. Okay, but you can start out to look at investing.com as a starter, right? So go in, register, and then you can keep, because once you register, you can keep your criteria. So every time you go there, you don't need to re-click those criteria. So yeah, you can check those out. There's plenty. Also talk to your broker. Some of the brokers have these stock screeners inside the systems already, right? So that could be quite easily and conveniently used.
Yeah, I believe Yahoo still has it because
yes?
the last time I used was I think 1 or 2 years ago. I still use it, but I mainly use it to screen, foreign stock Okay, not so much of local stock. That's my usage. Okay, right. The next question is by Shazila. What sort of analysis approach is better? Is it top down or bottom up?
Okay, now top down, bottom up, that will be basically depends on your a lot of that is used of course by analysts, okay, analysts looking for investment type of stocks. Okay, so whether you for me, right, I don't use top down, bottom up. I use a stock screener. Okay, because I'm a trader. My criteria is different. Okay, I'm not looking for price earnings. I'm not looking whether the sector is performing or not performing. Okay, and that honestly, a lot of the elbow work and all the hard scrubbing have been done by the research houses, right? So if you subscribe to the research house reports, they are already doing those work for you. And basically, unless you say you have all the data, you have your Bloomberg screen, you can never beat all those guys with those expensive stuff. We can do top down or bottom up. Okay. But yes, if you're talking about long-term investing, you can use those approaches. Okay. And you can leverage, I think nowadays, because research is so much available, even with your broker, okay, they produce fantastic reports. Those already, they do the work for you. Right. So you may be able to shortcut it, but if, of course, you love analyzing, you could do that as well. If you CFA type, you like analyzing stocks, you can do it. But I myself, I don't. I use a stock screener. I'm very simple, man. I'm a trader. Okay. Back to you, Shane.
Okay, I see. If I may share my view on this question, in short, I feel that if you want to do growth investing, you want to go to where the hot money flows to, I think you can do top down. If you want to do value investing, then you do bottom up lah. That's my view on this question.
Thank you, Shane.
Yeah. The next question is very pertinent to I think most of the retail investor feel lah. So in the current market condition where most of the sectors are either sideways or in the downtrend, so what would be more appropriate approach to screen suitable stocks for trading?
Okay. One interesting thing is I was doing a session last week with one of the clients from a broking firm, okay? And we were talking about stock screeners as well. So before I did the session, and at the time, the markets were really dropping as well, right? So I applied the stock screener. We used that. Of course, the stock screener in this time, right, the list of stocks that has those criteria that with the strong trends up, okay, because there are always these outliers that sometimes this are not affected by the general market sentiment, okay, although the main market sentiment is down, right, there are still winners there. That's why the stock screener is very important. If you can't basically eyeball the market, okay, you need to have something that can look through the data. Okay, run it through in the evening when you go back, put in the criteria, run it through, and then it gives you, say, a list of 5 stocks. And that time when I did the screener, there was at least 3 to 4 stocks that were fantastic. Looking at the charts, was very good. The trends were very good, and at least those stocks were tradable. Right. So even in the tough time, they are available. So you have to mine for it. So what the stock screener does is it mines for you. It does the hard work for you. And then after that, you analyze. Okay. Yeah. So yes, there is still some jewels that can be found in this market sentiment. Okay. But of course, if market sentiment lifts, okay, and then of course the tide will lift all boats as well, right? So and then you will be able to find more stocks, okay? But still, you are able to find some jewels even at this time.
Okay, thank you so much, David, for addressing the question. Let's do one last question by Leah. If I'm holding a losing stock for more than 5 years, should I just close my eyes and sell it?
Okay. If I had that, what I'll do is this. Some people, they say, I bought this stock, I put 100 grand, now it's only worth 5 grand. Okay. So I've been sitting there for years and for years. Okay. So basically, if you look at it this way, you have 5,000 worth of portfolio. Okay. Okay. Maybe not that bad, okay. Maybe 50,000, okay. 50,000 portfolio. Okay, this stock does not move. So we come to that rule, okay, exit rule. When the stock doesn't move, okay, basically that stock is basically sitting on your money and your money is not working, right? So in terms of looking at the exits, in terms of stop losses, in terms of exits, you saw already, exit when the market is a stop. So you've been holding it for a long time. So I suppose you probably should have sold the stock long time ago, but you didn't. So you violated rule number 1, okay? Maybe you didn't, or maybe a friend did, okay? And I have a lot of friends who did that, okay? So rule number 1, no airbag, okay? Now bad situation, okay? Now down to the 50 grand. What should I do with it? Okay, for me personally, if you ask me, I would liquidate this particular stock so that I can put it into something that can move. Okay, after all, it's 50,000 already. Although you imagine that you haven't taken a loss because you haven't sold your stock, but actually it's already lost in value. Okay, so your imagination is, if you deceive yourself to say that you have not lost because I have not sold, okay, not sold, that means haven't lost, I mean, don't kid lah. We know lah. We don't kid each other lah. We talk honestly. Okay, so it's already gone down. It's worth only 50,000. Okay, it may never be able to go up. Okay, very rarely do stocks that come down so hard. Okay, unless some big catalyst changes the whole situation. But the odds are against you. Right. So I personally would have switched that particular portfolio into something that's more worthwhile to go into, that will move, that's more volatile. So the odds are better that that date stock that you're holding can now be put into something that's more productive. Okay, that would be my strategy in handling that kind of situation. So I hope that helps you. And that's a lot of friends of mine are in those kind of situations as well. Okay, so might as well put into something good. Don't hold something that not going to move anymore. Put into something good. Okay, and learn from the mistake. Of course, there's if there's a mistake, learn from it, and then hopefully that when you move this particular portfolio to a different exposure, it will perform better. I hope that helps.
All right. Thank you so much, David, for doing this segment for us. I think all of us here now are more familiar on the various aspects we should look into when we want to design our game plan to win consistently in the stock market. So thank you so much, David, for your wonderful sharing for this webinar.
Thank you again, everyone.